Climate change is the next great challenge our economies will face. The problem isn't change, it's rapid change, change too fast for markets to adapt. Estimates put the social cost of a pound of carbon dioxide between 37 and 220 US dollars. 65 trillion pounds were released in 2017. This is Annika. She lives in Delhi, India. Her family grows rice. Like most farmers, she relies on consistent weather patterns. Climate change disrupts these patterns, making rains too extreme or too scarce. Rice production in India would have increased by 4% since 1960 without climate change. Global crop yields could fall by 35% within the next 80 years if greenhouse gas emissions continue on at their current pace. Climate change's impacts spread beyond agriculture and into infrastructure, health, and many other aspects of our daily lives. Let's look at how climate change has become a massive issue. Greenhouse gases are a result of economically valuable activities. For example, companies that produce air conditioners benefit from their profits. However, air conditioners produce hydrofluorocarbons, or HFCs, which cause 100 to 3,000 times more global warming than carbon dioxide. Air conditioner sales in emerging economies, like India, are growing 10 to 15% a year, yet companies producing the ACs in the US aren't seeing the effect of increased HFCs. Instead, people like Annika face the consequences. Impacts of emissions are external to the market that supplies the product. Since the cost doesn't affect the firm, there isn't an economic incentive to reduce emissions. This problem is known as the greenhouse gas externality. Framing climate change in this perspective means that economic theory can tell us how to help. Negative externalities, like greenhouse gas emissions, are the result of market failures that make the marginal social cost curve higher than the marginal private cost. Consequently, we produce more gas than is best for society. When it comes to reducing emissions, economic solutions correct externalities primarily through government interventions, like a carbon tax or cap-and-trade system. A carbon tax increases the cost of a company burning fossil fuels by a carbon price. Polluters are thus forced to absorb the cost of emissions. Cap-and-trade occurs when a government sets a limit on firms causing emissions. Companies with unused emission allowances can sell their remaining parts to companies struggling to comply. Both of these solutions face challenges. For example, carbon taxes may be politically unpopular. However, British Columbia has a neutral carbon tax, whose revenue is used to offset other taxes. Let's get ready for the next big challenge our markets will have to face. Please like and subscribe.